Have you ever felt like a stock was guaranteed to rebound simply because it had been falling for days on end? On the night of August 18th, 1913, inside the grand gilded hall of the Le Grand Casino in Monte Carlo, hundreds of wealthy gamblers gathered around a single roulette table to witness something mathematically astounding. The small ivory ball fell into a black slot 10 times in a row, then 15 times, and then 20 times. Believing with absolute certainty that red was long overdue, the crowd frantically stacked millions of francs on red, convinced that probability was on their side. By the time the ball landed on black for the 26th consecutive time, fortunes had vanished into thin air and the casino walked away with millions. What happened that night in Monte Carlo was not a malfunction of the wheel, but a devastating showcase of how human minds misinterpret randomness. That exact same psychological illusion quietly plays out in modern stock markets every single day, subtly draining wealth from your portfolio whenever you assume a falling asset has to turn around. This psychological trap is known as the gambler's fallacy, defined as the false belief that past random events can influence the outcome of future independent events. To explain it simply, your brain naturally expects short-term results to balance themselves out, creating an irresistible urge to bet against an ongoing trend. When applied to your personal finances, this mental flaw convinces you that after a series of down days, a stock is statistically required to bounce back. In stock trading, this cognitive bias shifts your focus away from analyzing actual financial health, revenue growth, or corporate balance sheets. This is educational content only, not financial advice. Instead of evaluating a company on its true fundamental value, you begin betting on arbitrary chart patterns and phantom odds. You end up treating the complex, living mechanics of the stock market like a simple casino game, making high-stakes decisions based on what you feel ought to happen next, rather than cold, hard facts. Why is your brain so easily tricked by this pattern? The answer lies deep within human evolutionary history, where early survival depended entirely on recognizing real patterns in nature. Our ancestors survived by linking dark clouds to incoming rain, or rustling grass to approaching predators, hardwiring our brains to constantly search for order and cause and effect relationships in everything we observe. When you apply that ancient survival-driven pattern recognition to modern financial markets, it backfires spectacularly. Financial markets are filled with immense amounts of market noise and independent data points that do not follow simple biological rules. Your brain actively invents narratives out of purely random price movements, tricking you into seeing predictable cycles where none actually exist, and putting your hard-earned prosperity at risk. To protect your wealth, you must understand the mathematical reality of independent events and memoryless systems. Imagine flipping a standard, fair coin 5 times in a row, and having it land on heads every single time. When you flip that coin a 6th time, the chance of landing on tails is still exactly 50%, because the coin has no memory of where it landed before. Financial instruments operate on similar mathematical principles during short-term trading windows. A stock price movement yesterday does not magically force today's market makers or algorithms to trade in the opposite direction to restore balance. When you expect a market asset to self-correct based purely on recent price history, you are projecting human desires onto an emotionless financial system that is completely indifferent to past results. Consider a realistic example of how this trap destroys actual personal savings. Imagine an investor named Mark who bought shares in a promising tech company at $100 per share. Over 6 consecutive months, bad earnings reports and shifting industry trends caused the stock to slide steadily downward to $80, then $50, and eventually all the way down to $30 per share. Instead of reassessing the company's failing business model, Mark falls victim to the losing streak trap, often called catching a falling knife. He convinces himself that after 6 months of relentless losses, the stock is practically guaranteed to shoot back up tomorrow. Driven by the emotional need to recover his money, he pours his remaining life savings into buying more shares, completely ignoring the reality that a stock down 70% can easily drop another 70%. While doubling down on a plummeting asset feels like taking advantage of a discount, it often pulls your hard-earned savings into a spiraling trap. To protect your wealth, you must understand a fundamental distinction that roulette wheels never have to deal with. Stocks are not unbiased metal spheres bouncing across wooden frets. When a coin lands on heads 10 times in a row, the coin itself remains entirely unchanged, maintaining the exact same 50% probability on the 11th flip. A corporate enterprise, however, operates in a world of living economic realities. When a public company watches its share price crater over consecutive quarters, that drop is rarely just random noise. It frequently reflects falling sales, massive executive debt, or a fundamental flaw in its business model that directly erodes your long-term prosperity. Assuming a declining stock is mathematically due for a rebound ignores these operational failures, confusing pure probability with underlying corporate health. Look back at the dot-com crash of 2000 through 2002 to see how this psychological trap plays out on a massive scale. During the late 1990s, companies like Webvan and Pets.com saw their valuations skyrocket despite generating almost no real revenue, fueled entirely by speculative enthusiasm. When the market finally turned, millions of individual investors watched these stock prices drop by 20%, then 40%, and continuously bought the dip because they believed these market darlings were due for an immediate recovery. Instead of bouncing back, those businesses filed for bankruptcy, completely wiping out the investment capital of those who treated falling stock charts like biased casino games. This psychological trap also works in reverse, quietly crippling your financial potential when markets are heading up. When you fall victim to the reverse gambler's fallacy, you look at a high-performing company that has posted 5 consecutive days of gains and instinctively feel a crash must be right around the corner. Driven by the false belief that green days must immediately be balanced by red days, investors rush to sell their best-performing assets to lock in modest profits. By cutting your winners prematurely out of phantom fear, you miss out on the incredible compounding gains that truly build life-changing wealth over long horizons. Yielding to these psychological impulses locks your financial life into a damaging cycle of emotional market timing. When you buy losing assets because you think they are due to rise and sell winning assets because you fear they are due to fall, you systematically execute the exact opposite of successful investing strategy. Decades of financial data demonstrate the tragic cost of this behavior, showing that retail traders who actively try to time daily market swings consistently underperform basic automated index funds. The mental anxiety of trying to predict every coin flip not only drains your peace of mind, but actively strips away your long-term prosperity. While emotional market timing routinely drains individual wealth, the underlying mechanics of market pricing reveal why trying to predict the next short-term move is so dangerous. When you rely on gut feelings instead of objective realities, you set your portfolio up against a fundamental truth about how price movements actually work. In his groundbreaking financial work, economist Burton Malkiel introduced what is known as random walk theory, the concept that stock market prices move in completely unpredictable ways in the short term. To picture how this works, imagine a person taking steps in a dark room, stepping left, right, forward, or back completely at random. Just like that traveler, tomorrow's price movement carries no memory of where the stock moved yesterday or over the last 5 trading sessions. Because these brief price fluctuations are effectively independent events, your brain's natural desire to spot recognizable trends becomes a trap. You might look at a stock chart that has fallen for 6 consecutive days and convince yourself that a bounce is guaranteed, but the market does not care about past patterns. Recognizing that short-term price movements are inherently random is the essential first step to protecting your hard-earned capital from costly psychological illusions. Accepting that short-term market noise is memoryless forces you to realize that professional Wall Street players operate under a completely different set of rules. Instead of guessing where the market will step next, institutional trading firms systematically harvest profits from everyday investors who fall victim to these cognitive traps. Behind the scenes of modern financial exchanges, quantitative hedge funds and high-frequency algorithms constantly scan market liquidity to locate clusters of retail stop-loss and limit orders. When retail traders collectively fall for the gambler's fallacy and double down on a falling stock expecting an immediate turnaround, these sophisticated automated systems detect the predictable tidal wave of incoming orders. Rather than joining the crowd, these institutional algorithms exploit retail desperation by filling those orders and driving prices down further to trigger automated stop losses. This forced selling forces individual investors to surrender their positions at absolute rock-bottom prices, effectively transferring wealth from emotional retail accounts straight into institutional coffers. This systematic exploitation of human bias by high-speed algorithms underscores why clinging to losing positions is one of the fastest ways to erode your long-term prosperity. When you double down on a declining asset out of a belief that it is due for a comeback, you are playing directly into a game designed to strip away your capital. The emotional damage of watching your portfolio shrink is compounded by a brutal mathematical truth that every investor must master. If an investment loses 50% of its value, it does not simply need a 50% gain to get back to where it started. It requires a massive 100% return just to break even. This stark asymmetry means that holding on to a plummeting stock while hoping for a statistical miracle severely damages your net worth. Experiencing a prolonged drawdown creates intense psychological anxiety, driving you to make increasingly desperate financial decisions in hopes of recovering your money quickly. The sinking feeling of watching years of hard work disappear in a matter of weeks is a painful reminder that hope is never a valid investment strategy. Protecting your wealth requires recognizing that cut losses early are far easier to recover from than catastrophic portfolio crashes. Understanding the brutal arithmetic of portfolio drawdowns clearly demonstrates why disciplined risk management must always override emotional impulses. This is educational content only, not financial advice, but shifting your focus from emotional predictions to objective mathematical realities is essential for maintaining control over your financial destiny. To protect your money from emotional traps, you can adopt systematic frameworks like dollar-cost averaging, which is the practice of investing a fixed sum of money at regular intervals regardless of share prices. Remember, this is educational content only, not financial advice. Consider an investor who automates a monthly contribution into a broad index fund. By scheduling these automatic transfers, they completely strip human emotion, impulsive timing, and psychological guesswork out of their wealth-building routine. By committing to this fixed schedule through every rise and fall in the market, the investor successfully neutralizes the urge to guess when a losing streak will turn around. Instead of wasting energy trying to outsmart daily price fluctuations, automated purchasing transforms short-term market noise into a structured, long-term accumulation of valuable assets. Recognizing when your brain is attempting to trick you during volatile market swings is one of the most powerful defenses you have for your prosperity. You can construct a simple mental checklist to audit your logic whenever you feel a strong impulse to make a trade. Whenever you find yourself thinking phrases like, "This stock cannot fall any lower," or "It is bound to rebound today," you are witnessing the gambler's fallacy in action. Replacing these emotional assumptions with an objective review of company revenue, balance sheet health, and fundamental business value ensures your decisions are driven by economic reality rather than hopeful predictions. Building sustainable wealth requires accepting that short-term price movements are driven by complex, independent events that cannot be predicted by recent trends. When you abandon market timing attempts based on recent streaks, you align your strategy with the actual mechanics of long-term capital growth. Across the financial landscape, this transition toward disciplined, automated investing has fundamentally altered how millions of families secure their retirement funds. Major institutions and pension plans have increasingly embraced rule-based allocation strategies, channeling capital away from speculative stock picking and toward low-cost index structures designed to safeguard wealth from human bias. Regulatory frameworks like the Employee Retirement Income Security Act of 1974 have continuously adapted to encourage low-cost, systematic savings plans within employer-sponsored accounts. This widespread institutional adoption highlights a growing consensus that removing emotional impulses from the equation is the single most reliable method for preserving capital over decades. On a personal level, conquering these cognitive shortcuts directly influences household stability. Families who resist the urge to chase false bottoms and instead follow consistent financial plans avoid the devastating losses that historically wiped out retail investors who tried to double down on falling assets. When you protect your money from the urge to gamble on market turns, those funds remain secure to build a lasting legacy, cover unexpected life events, and fund a comfortable future. The true human cost of falling for behavioral traps is lost security, while structural discipline turns market uncertainty into steady progress. Reflecting on decades of financial research, from the groundbreaking insights of psychologists Daniel Kahneman and Amos Tversky in the 1970s to modern behavioral data, one enduring truth stands out. The markets will always reflect a dynamic tug-of-war between statistical reality and human emotion, but your long-term prosperity is ultimately defined by your commitment to clear objective principles. When you look back at that legendary night in Monte Carlo on August 18, 1913, the greatest lesson isn't just about a roulette wheel spinning black 26 consecutive times, but about how easily your mind can fabricate patterns where only randomness exists. In modern markets, where financial capital shifts in fractions of a second, based on cold mathematical models, clinging to psychological illusions about what is due to happen can quietly undermine your long-term prosperity. True wealth protection comes from recognizing that the market has no memory of your last trade, leaving your financial future secure not by guessing the next turn of the wheel, but by honoring disciplined, patient principles. Remember that this is educational content only, not financial advice. If you want to stop trading time for money and start building real wealth, hit subscribe. We break down exactly how. If this video helped you, hit like, share it with someone who needs to hear it, and drop a comment below. What's one habit you're changing to protect your prosperity? If this helped you, go check out another video on our page next.